Despite what the Biden administration will tell you, the US economy is not going well, and you've heard this before, no doubt. Inflation is higher than they're telling you, cost of living is still increasing, we see mass layoffs every week, and GDP is being inflated by millions of migrants being pumped into the country. But what you likely haven't heard about is the coming crisis with US Treasury actions. In essence, when the US government wants to take out more debt, they have to create Treasury bonds and sell them, and they need to sell them to real people or institutions. But the number of those real actors willing to buy them is dropping lower and lower, and at the same time the US government is selling more and more of these treasuries. And what happens when the US government goes to sell those treasuries and finally the chicken has come home to roost and there are simply not enough buyers? Well, that's what this entire video is about. But why is this actually happening? Well, there are essentially three factors at play here causing this crisis, and if they continue to play out, that means the crisis will continue to evolve. The first factor at play is that the government is spending more and more every week as the debt burden and servicing costs required to pay that debt burden continue to rise. We hear constantly about how great compound interest is when it comes to our investing, but when it comes to debt, compound interest is just as influential, except in the opposite direction. And of course, people know that this is the case. It's impossible not to, but most people don't know the numbers behind why this is so damn crazy. The US national debt currently sits at $34.5 trillion, and it's increasing by another $1 trillion every 95 days at the moment. Over the next 6 years, it's expected that the national debt will rise to an insane and ridiculous $54 trillion, according to the Congressional Budget Office. Back in 2010, the cost to service this debt was 1.2% of the entire American GDP. In 2019, it was 1.8%. Right now, it sits at 2.4% and will be just under 4% in a decade's time. In just 18 months, the total cost per year will rise above $1 trillion just to service the interest on this debt, which is enough to wipe out the entire GDP of every single country in the world outside of the top 20 largest economies. The entire Russian economy produces roughly $1.8 trillion in productivity each year, and soon enough, the US will spend $1 trillion simply on paying the interest on its debt. So the government is taking out more and more debt in the form of treasuries at an accelerating rate, meaning the supply of treasuries is literally skyrocketing. Now, the second factor here is that demand for these treasuries is softening at the same time as supply is rising, and demand is falling for two separate reasons. Firstly, there are fewer foreign buyers for these treasuries than there used to be, and this number keeps going down as well. Why? Well, can you take a guess? It's related to how the United States has essentially made it official policy to weaponize the US dollar and to use it to manipulate foreign countries, and this only works for the US government if foreign countries actually hold lots of dollars or treasuries. Ever since Ukraine was invaded and Russia was hit by sanctions, this effect has been accelerating, but it isn't even just about Russia. China and the US have seen relations sour, so have Brazil and Saudi Arabia and South Africa and countless other countries too. Even Europe is enduring a near constant spat with the US right now, and every country has to consider what might happen if relations continue to sour. How might the US use their dollars and treasuries to influence another country? A far cry for France, the UK and Germany maybe, but if you're in Saudi Arabia or China and you've already been exchanging harsh words, expelling diplomats and accusing each other of subversion, well, it isn't such a reach for these countries to feel a little bit uneasy about buying up so many treasuries. And if you're just an individual investor in one of these countries, it's also hard not to take note of how difficult it's been for Russian citizens to access their capital over the last 2 years since the invasion of Ukraine. But of course, there's actually another factor impacting the demand for these treasuries, and that's quantitative tightening. Now, for years, we saw the opposite, quantitative easing, which is essentially a fancy word for money printing. But as inflation has been high for years now, and as it was at literal crisis levels mere months ago, the Federal Reserve has been forced to enact the opposite of money printing and start withdrawing liquidity from the markets using QT. When liquidity improves, it means there are quite literally more dollars in circulation and more dollars get put towards buying up treasuries. And we're currently experiencing the opposite of that effect right now, with fewer dollars, not more. So demand is naturally falling. And actually, it has been falling consistently for months on end as we speak. So we have the number of treasuries that the US needs to sell skyrocketing, and we have the number of dollars around to buy these treasuries with falling, and we have the number of actual buyers to pick up those treasuries falling as well. Suddenly, it doesn't seem like such a surprise that the US is quickly advancing towards a point where the US Treasury auctions will fail and there will simply be no one left to buy up all this debt. Now, the next question on everyone's minds is, will this get better or worse? And to tackle this, we simply need to take a look at the root cause once more. The US government is ridiculously bloated, and many people believe this is a result of a Democratic president. But in reality, while Trump was president, the state didn't shrink in any way, and it actually continued to grow. And yes, the rhetoric pushed by Republicans today certainly seems tough at times, but Republican actions speak a different language, and it seems clear that their true agenda is also to continue the enlargement of the US state. This is actually far more common than you might think, and we see this exact same thing happen in other countries as well. In the United Kingdom, for example, the Conservative Party have been speaking about shrinking their state, cutting budgets and saving money, but they've been in power for well over a decade at this point, and the state simply keeps getting larger and larger, not smaller. And at the end of the day, votes are won by promises, not actions, and so parties pander to their demographics to buy up votes, and then they simply ignore all the statements they made that actually got them elected. And on the front of reduced foreign investment into US treasuries, is there at least some good news coming there? Well, geopolitics has been getting more radical with worse tensions, not better, so it's very unlikely. Every time things finally feel like they're about to calm down again, another spat with China erupts, another threat to world shipping emerges, or another war in the Middle East kicks off. The Russian invasion of Ukraine is still raging, and neither side is showing any willingness to back down, and the West is still firmly committed across the board to supporting Ukraine and keeping the bullets firing. Okay, I hear you. At least the inflation problem is over though, right? Well, wrong. Just this week, updated data on CPI figures in the US released, and on the surface, things look okay. 3.2% headline inflation over the last year, not good by any means, but not awful numbers to be seeing there. But actually, month-over-month inflation was 0.4%, which when annualized is actually 4.9% inflation, and the next month coming is obviously March, and last March, month-over-month figures were 0.1%, which means the year-over-year figures are going to spike in a major way in about 4 weeks' time, revealing this true problem to millions of people. And let's not forget that inflation is the rate of change of prices, not prices themselves. Every single month with inflation in positive terms means prices are getting higher each day, and the simple fact is the Federal Reserve doesn't have the gall to hike rates high enough to actually fix this issue, and the US government is currently fighting the Fed by spending as much money as humanly possible in an attempt to disguise the true state of the economy. All this to say, inflation is not fixed. It's still a massive problem, and that means yields on bonds are going to stay higher and likely even get higher again, and that means a larger cost to service the national debt, which means even more greater supply of treasuries in the future. Put very simply, the factors causing these problems in the treasury markets do not change overnight. They see trends that last for years and decades, and those trends are getting worse, not better. So for us to sit here and assume that overnight shaky geopolitical state of the world will fix itself and the US national debt will shrink and that US politics itself will fundamentally change and that inflation will fix itself is simply deluded. Very quickly, we are approaching a point where the US government tries to borrow money and there will likely not be enough buyers to actually take on those treasuries. We've been seeing the US Treasury auctions get worse and worse over recent months, with as much as 21% of the bids going unanswered and the rest of those treasuries going for higher yields that the US government literally has to accept. And this problem will continue to grow. We will at some point witness a failed auction where the issue isn't the US government paying more for their debt, it will be them literally not being able to take out the debt that they need. Now, the federal government isn't going to go into default and run out of money instantly. They have about $700 billion set aside for that eventuality, but they will be forced to take drastic changes to make sure the next auctions don't fail, or else they will run out of money. What does that mean? Well, simple. Quantitative easing once more. Money printing starting back up again in order to flood the market with liquidity so people actually want to buy these treasuries again. Of course, this will likely go hand in hand with a crazy spike in treasury yields and a large drop in the stock market, as well as investors around the world losing confidence in the US dollar. But more importantly than either of those, that is inflation rising fast once again, causing this whole cycle to continue for another 5 years minimum and inflicting untold financial pain onto hundreds of millions of Americans.